Hello and welcome to another of our weekly webcasts where you get the chance to ask James McManus, our CIO, any questions you like about investment and the markets. Here he is. This is James McManus. CIO stands for Chief Investment Officer. In a minute, he's going to give us a presentation. When we recorded this webcast live, James had a few problems with his sound. So for this version, which we're hosting on YouTube, we've re-recorded the presentation. Over to you, James.
Thanks, George, and good morning, everybody. Thanks for your patience with some of these sound issues, and apologies I dropped off the earlier call. But thank you mostly for joining what is another weekly webcast from Nutmeg. I hope you and your families continue to be safe and well, and you had an enjoyable Easter. And as always, thanks for trusting Nutmeg to manage your investments. So here's what we intend to cover this week. First, we'll take a quick look at what has been going on in financial markets since the past webcast last week. I'm then going to talk about what's been going on in property funds, UK property funds in particular, and whether we have exposure to UK property funds in our portfolios at Nutmeg. On the back of last week's slides, on the UK stock picking strategies, we had a number of questions regarding property funds and the suspension of dealing in some of the most well-known funds offered to investors in the UK. And of course, we'll have more time for more of your questions. Much like last week, we've deliberately kept the presentation short in order to make sure we can answer as many of these as possible. So firstly, what has been happening in financial markets over the past week? Well, it's actually been a very short week since our last webcast, with only 2 trading days in both Thursday and Tuesday in Europe. However, not all financial markets are closed for both Friday and Monday over Easter, and those in the United States and other areas of the world continue to trade on at least one of those days. And in fact, the past week or so has actually been a very positive one for riskier assets, such as equity markets. Stock markets continue with their risk on stance through the week, last week into the Easter weekend, with sentiment being buoyed by flattening infection rates, lower hospitalizations, and falling death rates in some of the major COVID-19 hotspots globally. But we also saw a lowering of expected fatalities in the US that was also good for sentiment. And the S&P, the US stock market, had its biggest week again for 45 years, and in fact registered a 20% recovery from its low point in March, so technically pulling itself out of bear market territory. However, it still remains more than 15% lower than its February peak. So despite the near-term euphoria over the potentially better outlook for from a medical perspective, and the talk that we've seen, the move to talk of ending lockdowns that we've seen in the past week, we continue to see economic analysis that points to the true cost of the crisis. We've had major reports out this week from both the IMF and from the OBR in the UK. Now, the IMF warned in its global economic outlook that the magnitude and the speed of the collapse in activity that's followed the global shutdowns is unlike anything we've experienced in our lifetime. They now project a negative 3% figure for global growth in 2020, and they're warning that the speed of the revision in growth makes what they're calling the Great Lockdown on course to be one of the worst recessions since the Great Depression, but in terms of year-on-year GDP growth. So really speaking to the speed at which we've seen that revision. They do, however, note that much depends on the trajectory of the virus. They also expect in their base case a strong recovery next year, so reasons to be positive as well. In the UK, the Office for Budget Responsibility, the OBR, forecast the UK's economy to shrink by 35% in the second quarter of this year, before then rebounding in the third and fourth quarters and returning to pre-crisis growth levels at the end of 2020. So a short, sharp, very painful hit to growth expected from the OBR. The OBR also forecasts the largest budget deficit as a share of GDP since World War II for the UK, really speaking to the level of spending, the fiscal spending that's going on. And they also noted that unemployment may peak around 10%. But it's worth again noting here that there are assumptions underpinning these forecasts that could turn out to be too optimistic or too bearish. For example, the length of the lockdowns expected. But reasons to temper the excitement that we've seen in markets in the past couple of weeks around falling infection rates, and a reminder that we're yet to see some of the true economic impacts of what has gone on over the past month or so. Now, in the commodities market, investors had eagerly awaited last week's teleconferences between the major oil producing nations globally, really in the hope that they would conclude those teleconferences with a cut to production volumes of crude oil. Investors got what they wanted. They got their cut to production on Sunday when it was announced that the OPEC Plus partners and the G20 nations that joined those calls had agreed to cut 9.7 billion barrels a day. That's roughly 10% of global output. And on top of this, actually, the US, Canada, and Brazil will contribute a further 3.7 billion barrels, 3.7 million barrels as their production declines in the coming months. So this is a significant achievement. It marks sort of an end to a price war that has been brokered by President Trump in the end, and he becomes the first US president for some years to actually push for higher oil prices. So potentially the end of a price war, but not necessarily the end for lower oil prices. And in fact, despite initial optimism, the Brent crude price has actually declined back below $30 a barrel since that was agreed. That's partly to do with the fact that this agreement doesn't take effect for another 3 weeks or so. So those countries that are pumping oil at record levels are free to do so up until May. But it's also about the fact that supply is not the only issue for the market. At a time, as we've discussed before, at a time of depressed global activity, demand has really fallen sharply, and the oil market is now concerned more with demand than it is with supply. Away from the commodities market in the US, we've seen further rounds of stimulus. The Federal Reserve again flexing its considerable stimulus muscles by announcing another package of $2.3 trillion in loans to support businesses of all different sizes and local governments, and really making clear statements that their role here is to provide as much relief and stability as they can in this period of constrained economic activity, and to make sure that they're ensuring the eventual recovery can be as vigorous as possible. So really focusing on how they can maximize a short, sharp recovery. They also extended their mandate in the corporate bond market to allow the purchase of high yield corporate bonds. Those are bonds with lower credit ratings, and that will help support an area of the market that was coming under significant pressure. And I think the Fed announcing that recognizes the pressure that area of the market may have been coming under. Close to home, the EU finance ministers also finally agreed a rescue package for the countries that have been hardest hit in the EU by the virus. That included a provision from the EU's bailout fund to guarantee spending by indebted countries that are under pressure. But I think here really the key takeaway has been that the length of the negotiations required to get this over the line, the failure to agree the financing routes by the close of those talks, and a total package really that falls short of what was recommended by the European Central Bank at the outset, really outlines the political issues that Europe still faces in responding to the crisis really efficiently as a bloc. Speaking of Europe and closer to home, the UK and EU will rebegin their Brexit negotiations in the next week or so. Those negotiations were, of course, delayed due to both chief negotiators experiencing symptoms of COVID-19 and therefore unable to participate in negotiations. We think it's really likely here we'll see Brexit come back to the fore and really come to the front of investors' minds as we approach the summer. Negotiations by now should have concluded 3 stages in what was really a quite constrained timeline to begin with. There may still be time to discuss an extension, but that would require it to be ratified by June. And there's likely going to be significant opposition to this in the UK, given the mandate that the Conservatives won in the most recent election. So I think Brexit will be topical. It will come back to the fore and be front and centre of investors' minds as we enter the summer and we start to understand whether it will be possible to negotiate a deal in the very constrained timeline that's left. And then finally, earnings season is now underway. So this is companies all over the world reporting their earnings for the first quarter. We started the earnings season in the US yesterday, and it's likely we'll see the impact on first quarter earnings in the US is probably relatively muted because the nationwide restrictions on activity there only really came in the second half of March. But they will be very useful in helping investors understand what companies are experiencing and how companies are planning for the operating environment ahead. and what they're seeing already in terms of knock-on effects in areas like consumer sentiment. So we did have some earnings already in the past 24 hours, a couple of large US financial firms and banks. That included JP Morgan, Wells Fargo, both of whom major banks delivered poorer results than was expected, but both of whom also set aside large sums of capital to account for future expected losses on their loan book. So we expect to get much more insight in the week ahead into what has been the effect so far on companies, and that's going to be really helpful in informing investors' views on the operating environment going forward. So on to a slightly different topic, and this is one that we again have received a number of questions on in the past couple of weeks, and that's UK property funds and actually property funds in general. So I suppose firstly, what is a property fund if you're not familiar? Well, it's essentially a mutual fund that is going to allow you to pool your assets with those of other investors in order to buy investment assets. But unlike many mutual funds, in this case, the assets you're going to be buying are not primarily stocks and bonds, but actually buildings, warehouses, office blocks, retail outlets, commercial property. So this isn't residential property, this isn't houses, this is commercial property. This is property that is primarily let to businesses across different economic sectors. Now, property itself can actually be quite an attractive investment. It can offer diversification within a portfolio. It can offer a relatively low correlation to some other investment assets, such as equities, or in some instances, bonds. It can provide attractive and relatively secure income streams from the property rents that you're receiving, alongside, of course, the potential for capital appreciation in the values of the property themselves. However, property is typically deemed quite an illiquid asset, and that's where we think it can be more risky than its relatively stable income profile may first appear. And it can be very expensive and timely to buy and sell property. There are many costs involved in doing so. The costs as a proportion of the value of the asset are typically much higher than they would be for asset classes such as equities and bonds, which would be considered more liquid. And I think this is really where we have an objection to property funds at Nutmeg, and this is because many funds, despite that underlying time that's required and costs that are required to provide liquidity, still offer investors daily liquidity. That is, if you'd like to withdraw your money on a daily basis, you are able to do so. But clearly, the underlying assets are typically much more liquid than a daily liquidity profile would allow. So what does this mean? It means when a fund experiences withdrawals, a significant level of withdrawals, it's not going to be able to sell all of its underlying holdings as quickly as maybe investors would want to withdraw their funds. And this is really where a mismatch has occurred and can occur. And the FCA, I think it's interesting that the FCA has previously described commercial property as an asset as inherently liquid, which in their terminology means it's a liquid under even normal circumstances. But what we see is that the property market in the UK, the commercial property market, is intrinsically linked to the health of the wider UK economy, and therefore commercial property valuations can be quickly affected by shifts in economic sentiment. We saw this back in 2016 after the EU referendum. That was the last time we saw redemptions suspended on a number of property funds, and really that's to do with the uncertainty that is raised by that economic environment on the valuations of some of these commercial properties within the funds. So far in 2020, we've seen a number of high-profile funds suspend their redemptions, stop allowing investors to withdraw funds, or in fact even invest more. That's around 10 funds at the moment that have suspended redemptions, around 13 billion in assets. And the primary reason, as I said, for suspending investors from accessing their capital has been a material uncertainty over the value of those assets. So little comfort for investors that are stuck in those strategies. But worse still, we think when we do get that clarity on valuations, this could result in some further markdowns for funds that invest in sectors hardest hit, such as retail, travel, leisure. So at Nutmeg, we don't invest in physical property funds. We think property can be an interesting and diversifying asset class in portfolios. But we think for physical property funds, there's really a significant mismatch between the liquidity of the underlying assets and that as promised by the daily liquidity of the funds. So we're able to own property in different ways. We're able to own property shares, REITs via ETFs. But a core part of our offering here at Nutmeg has always been based around liquidity. And therefore, we've long held the view that UK property funds, the daily liquidity property funds, are not structured wisely in this regard. If this is something you're interested in reading more about on this topic, as some of you may be, it is something we've written about in the past on Nutmegonomics. And in fact, even as recent as last year, we were warning that the suspensions in these funds would be inevitable if the outlook and the sentiment for UK property worsened. There are a number of articles on Nutmegonomics there to access. But I hope that explains a little bit more about UK property, what has been going on in those funds, and then also why we don't own those in Nutmeg portfolios. And I think we'll stop there. That concludes the slides that we have for the presentation, and now we can open up to the Q&A session.
Thank you, James. Yes, that is the point where we would normally move to Q&A. We're not going to do that on this recording because we've already done a Q&A today. So if you're interested to see the topics that were discussed and the questions that were answered there, please have a look at the other recording that we've made today, which is also on YouTube. And if you'd like to have a question answered next week, please do submit it to us and tune in at the same time, 11 AM every Wednesday. We'll try to answer your questions then. I'll just quickly mention Trustpilot. If you are a Nutmeg customer, if you've had hopefully a good experience with Nutmeg and you'd like to share some thoughts or comments about that, a great way to do that is to leave us a review. You can find the right page by searching for Nutmeg Trustpilot. That's Trustpilot, the consumer reviews service. This kind of feedback is helpful for us and it may help other potential customers on their potential journey too. I'd also like to highlight that our partnership with Great Ormond Street Hospital Children's Charity is ongoing. Great Ormond Street Hospital Children's Charity relies on people's generosity to make a real difference to seriously ill children and young people. We're donating £25 for every Nutmeg Junior ISA account opened, and we'll also match any donations you make up to £100. You can learn more about this at nutmeg.com/JISA. Capital at risk, JISA rules apply. Thanks again for tuning in. Hope to see many of you again next time.